All right, good evening, everybody. Welcome to tonight's presentation, Tips to Get the Odds in Your Favor. It says a free event for members. It struck me as I was finishing up this one, who is this exactly intended for? Because there are all these tips and comments and I think a lot of really good information I give you guys, but yet who is it that really is benefiting from this? Well, one answer might honestly be I don't really know. I'm not sure. It's up to you guys. I think what I have always targeted to try and do, as I think you know, is I don't push what I do really at all in terms of the stuff that you would get charged for. I feel that people, when they feel the time is right and they decide that they need to understand charts or really want to make money for real, I think they know where to go and what to do, and I don't even think the price matters at that point. I think it's just a matter of, that's what it was for me. I'm not going to tell you that story now, I don't have time tonight, but you know how I got started. When the day came, I didn't care what the price was, and if you don't want the information, you wouldn't take it if I gave it to you free. If you weren't interested, if you didn't like me, if you didn't think technical analysis was good, or if you simply just didn't feel the time was right for you to devote to learn right now, I could give you everything free and you wouldn't even come or attend, right? It wouldn't matter. So who is this really intended for? It's really kind of intended for those people who are very interested, who want to learn, but the time just isn't quite right yet. There's a lot of people out there that I think are sticking their toes in the water, just trying to wrap their hands around how do I make money in the market? Is it really technical analysis? They're kind of feeling their way around, and that's a smart thing to do. And that's why I never ever push people or have sales or anything like that. I think it's what people do, and I think most people, to be honest with you, are probably around 6-9 months before they get serious about doing something. Of course, some people never do. So who is this for? Well, it's for those people who are haven't really officially learned it. And of course, all of my seminar room members, most of them attend these because they think there's great additional information. But this isn't where you learn how to trade per se. It's where you learn a lot of extra good things that I think you need to learn, even if you are educated in the markets, or if, like I think most of you are, maybe some of you have been around. There's a good number of you I know have taken some kind of classes or seminars somewhere else, and maybe online, and maybe paid way too much, maybe didn't pay much at all. And you just aren't convinced, so you're probably just kind of still, kicking around and trying to figure out what the right thing to do is, and that's fine. That's exactly kind of, I guess, who I accommodate, because I think that's the vast majority of people out there. So these tips tonight, I think you all understand this is not a replacement for learning the charts or learning how to trade, of course. These are things that even after you have maybe a handle on some things or you're trying to learn for yourself, these are things that I think really go a long way to help people. I sent out an email yesterday. Did you guys all get that? It was an educational email, which I do occasionally for all the members. It went out to all members, not just people who take classes or stuff. Did you guys get that? If not, you should have. If you're here, you're on the same list that got the email, you should have received it. I got an overwhelming reply back, and that's what made me have this little talk right now, because the overwhelming reply was, wow, this is just fantastic. And I'm thinking, well, it wasn't that good. I mean, it wasn't that big of a deal. I'm just trying to throw out some extra information there. And so many people just loved it. And I do have another, I mentioned in that email, I was going to do another one, which I will have coming out to you today or tomorrow, kind of a separate topic, but I think another very important one. And that's what the purpose of tonight is. It's the same thing, to try and continue to give you some good information. And as you know, that's also provided to you through the other free stuff that I do besides these events that happen about every 3 weeks on average. Sometimes I'll get 2 in a month, sometimes 1 a month. There's also a lot of information available to you with the free stuff page, where there are recordings of these prior events. If you've missed any of them, I think, my opinion, I think they're all great events. I don't know if I could really recommend one over the other. And there's also other free information. There's Trade of the Week videos are there if you go to the website, and click down. I think most of you know that by now. But there are new people coming on all the time, and I do want to make sure you know where that is. Here is the direct website to get there, because it's kind of hard to type disciplined trading strategies, but once you do it once, Google will take over from there and it'll fill it in for you. That's to the free stuff page, and actually from there you can go to the home page wherever you want to go, and there's Also, other educational videos that I keep adding more to the collection out there, including a new section for newbies. So go out and cruise around that whenever you want to and have fun looking around out there. Here is tonight's topics. Oh, before I get started, I want to mention one other thing. I am going to be sending to you very soon, like today, tomorrow, over the weekend at the latest, an email I was kind of working on for a week because I wanted to just throw out some thoughts and then kind of refine it so I don't say anything stupid. But it's going to be a different email. Rather than an educational one, it's going to be something you probably don't care about at all. But it's going to be actually about the business side of DTS. As you know, I don't want to give away all the stuff in the email, but I went off on my own 18 months ago. It's already been about 18 months. And after many, many years, being with another company, and I never went off on my own because I didn't want to deal with the business aspect of things. And you know what? It really has not been bad at all. It makes me regret not doing this a long, long time ago because my ability to teach properly is so greatly enhanced, and I can do things I want to do them the way I want to do them. But I've just wanted to give you a little update on, just kind of the business, so to speak, any little changes that may be coming, and some things to look forward to. So when you see that email coming, it'll probably be a fairly long one. It's not going to be a real important one, but you'll probably have that coming. And you may also have a few more emails from me in general than you normally do, or from DTS. As I looked over them, 90+% of all the emails you get, if you remember, are just purely educational, upcoming events, that type of stuff. But you may get a couple extra ones in the upcoming couple weeks about some small changes and things. So no big deal, just thought I'd fill you in. All right, here's tonight. Tips to get the odds in your favor. The 4 things. Use a variety of small tactics. Now, that doesn't mean small tactics. It means use a small variety of tactics. That sounds confusing. It is a little bit. I'll explain it. Be smart enough to be the second one through the door. Am I encouraging you to wait or to be faster? Well, that's confusing also. Everything tonight's confusing, but I will explain it all. Worry about what you make, not what you miss. Does that mean that we should be following an expression of making sure that missed money is better than lost money? And actually, I don't even believe in that, so that's not the theme either. And confidence. There's one word. Confidence is funny because it's probably the toughest one to get. I meant to clip out, I'm going to have to find it. I meant to clip out a little quote that I have about confidence, and I forgot where it was, but I will look for it. So let's begin, because every item is a little bit confusing here. First one, use of a variety, small variety of tactics. Confusing? Maybe. There are 2 sides to this one in a sense when I say use a small variety of tactics. And again, I'm giving tips to help make you better as a trader, investor. Doesn't matter, day trader, long-term trader, swing trader, whatever you want to call it. If you get into and out of positions in stocks or Forex or the market, what can we do to help make you better? The first rule, this is not the point of this section. In other words, this is not why I put the first tip. Use a small variety of tactics. But the first rule I do want to remind you of is that it's kind of the other side of the coin. Traders have to focus and learn specific strategies. In other words, when you first come to the market, the average person has no strategies, right? You know what's ironic is, and I thought about this when I was trying to think of how to phrase this, if you have no strategies, you really have every strategy. Does that kind of make sense to you guys? In other words, if you don't know what to do, you're forced to do everything, right? It's kind of almost synonymous. If you don't have a strategy or a concept, then your strategy or concept is everything, which is ironic. I don't know where else in the world you could say that probably, but it's kind of true. So the first rule is, hey, you can't come in just shooting from the hip. That's a little penguin shooting from the hip there. And just look at everything and say, oh, gee, that can't go any higher, I'm going to short it, and oh, gee, that can't go any lower, I'm going to buy it, and oh, gee, that looks bullish, and oh, gee, they just announced that they're buying a company that's got to make it go higher, go lower, whatever it is. All that stuff just doesn't work. We need to have precise things so we can measure what we do and be able to duplicate it. It's one of the biggest things I say to people when they say, is this a good strategy plan? One of the big tests is this. if you do something on Monday and you do real well, and then you do some stuff on Tuesday and you do really poorly, my question to you always is, on Wednesday, can you go back and replicate what you did that was good on Monday, and can you avoid what you did wrong on Tuesday? If you did anything wrong at all, you maybe didn't do anything wrong. But are you able to replicate the good things that you do? That's kind of what almost the definition of a strategy is, in a sense. So step one is we have to narrow down the huge amount of things that you could do out there to some favorite things that we want to do. But the point of this is then you can get too focused. You can get too focused in terms of both strategies and tactics. Now, I don't want to get into the distinction. For the most part, I just say strategies and I don't use another term. I guess I have to kind of offer a quick definition, and I may not even be right, so don't argue with me if it's wrong, but a tactic is kind of a sub part of a strategy. And this isn't really necessary to understand trading, but I'm using the word. Because what I mean is we want to be focused in terms of either strategy and or tactics. And tactic may even just be having multiple symbols to use to carry out a strategy. What do I mean by all this? Well, if you come to the market, and some people, let's say, and I'll give an example. I like trading futures. I think it's a good thing for those of you who do it. There's a lot of good reasons to do it. Liquidity and shortability and leverage and all kinds of good stuff. But there's a huge disadvantage to it I talk about, and that is the fact that you are trading one thing. You're trading one entity if you're trading the market. And if you don't like the market that day, if you missed it, if you blew it, you have to have the patience and the ability to sit on your hands, or you're not going to succeed. And this is one of the biggest things that kicks people out. Now, if you are doing just the market because that's what you want to do and that is your style, that is great. If you're doing the market because you're forced to do the market because you're forced to trade futures, that can be a bad thing. And you have to very carefully monitor. You may be having a hard time, not because you're a bad student of the market, not because you're maybe not smart enough or because you don't have the right tactics, but maybe it's just very hard to have the discipline to do one thing. I don't have that discipline, if that's any comfort to any of you, to be able to sit there. And that's why I like this section, and this is why I put this as one of the tips. And here we get to the heart of the tip, which is to have a small variety of tactics. In other words, I come to the market array, this is my watch list I give to the room, and what I use. I mean, I would do this, I wouldn't put this in a nice little cute little chart like this for myself, because I just have it on my screen. But I put this out there for the room, and what this is these are a variety of things I could do that day. Now, as many of you know, I look at about 1,500 symbols every day, about 1,500 symbols every single day. And this is what it boils down to, a couple handfuls of things that I think are the best of the best to be looking at. And this is what I focus on for the most part, but there is some variety. So if I have a very specific type of tactic I like to do, a specific strategy, if I'm only looking at one symbol or two symbols, what if it just doesn't do what I want it to do? What do you do? Are you guys following me? Yes or no? 100%? 50%? Or ZZZ, you fell asleep because you don't have a clue what I'm talking about? That's what I'm checking over, because these are some weird topics to me in a way. In other words, in my mind, this is so clear, it's unbelievable, but I could understand it explaining it. Some of you may be, what the heck are you talking about? Okay. So one example is that you could have this one pretty focused strategy you do, but you come to the market just looking at the market or looking at one stock that gapped up or something, and you have to look at it. And see, the thing is, it's never the case, never is it the case that you could have any kind of strategy where, oh, I'm going to be short that, or I'm going to be long that. I mean, it just can't be, because before the market opens, you could have a bias or an inclination or a desire or a thought to be short something, but something has to happen to make you short it, right? It has to prove to you that it is going to fall. Nobody, unless you had insider information or something off the wall like that, where you just, oh, okay, today the stock's going to make an announcement midday and I'm going to short it because I could care less about anything else. But I mean, other than that, we need to kind of have some proof. So we always need some kind of a thing to happen. And what if that doesn't happen to your stock you're looking at? Well, then you just sit there all day. Or what happens most of the time, guys? If it doesn't set up just right, you got one thing, it's not doing, you have this gap you liked and it's not doing what you want it to do, what typically happens to you? Right. You force the trade, it's called. You force it. You say, well, you're going to chase it way over here, even though you know that it's halfway to the target already, or you're going to take it going the wrong direction because you think, yeah, well, that's what you should do, Murphy, is you keep looking, right? But my point here is that if you don't come to the market with a small variety of tactics. Now, I kind of start talking about having multiple symbols to carry out one strategy, but there's another part to it too, and that is I do think you have to have a couple of different strategies or tactics, whatever word you want to use. Because what if, for example, your main bread and butter is you buy breakouts on the 15-minute chart going from one day to the next? Boom, 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 boom. Okay, great. But what happens when you're up 8 days in a row and the last day was really an accelerated day and everything is just overextended off the chart? Do you just keep doing that one strategy because that's all you have? Or do you say, hey, I have to kind of get a second concept in here because not every day is exactly the same. If every day was identical, we'd only need to do one thing. We could all pick our little corner and sit there and do it. But every day is a little different. Some days we kind of expect are going to be sideways, some are going to be big screamers up, some are big screamers down. And having only one way to take a piece of the market is going to be difficult. You have to have some different tools in your belt, so to speak. Does that make sense? The truth of it is, the fewer strategies you have, the better it is, the more focused you are, if you have the patience and discipline to wait. That's the balancing act you have to do. What do I recommend for most people when you're starting off? Try to perfect a couple strategies coming out of the gates. Try to perfect a couple things really well. And if you conquer those, then maybe go on to a third or something. I talk about something called a wild card play, where you may have two strategies or that you do routinely, but maybe you have a little appendix, if you will, of other things you like to do, and every once in a while something exceptional shows up and you just allow yourself to take kind of a wild card trade every once in a while, as long as those stay profitable. But however you do it, you have to find that balance between focus and discipline. Because if you do not do that, then it's the old expression. If your only tool is a hammer, then everything looks like a nail. You end up forcing trades, and you have to find a balance. But if you come to market with strategies you're comfortable with, and do your homework, and have the best of the symbols in front of you, then you are going to do well. Okay? I said every little concept I have would have an example. When I pull examples for a presentation like this, by policy, I have since the beginning of time, I only pull trades that I did the last 2, 3, 4 days. Why? Well, on one hand, you might say, gee, you could find a better example of what you're talking about if you went back to 2 weeks ago, 4 weeks ago, the year 2008. But I don't think it's very impressive. See, what I always try and teach is the stuff that I talk about is stuff that I do every day and can find examples of. Now, naturally, I could be talking about examples of bad things and have to go, just find charts for that. When I'm talking about trades and the way to trade, these are all things from recently. So I'm just going to show you a couple things that are from the last couple of days. And for this example of what I want to show you here about having different tools is actually going to be the trade that I sent out in the email yesterday, because it's a good example of this, and that was the Juniper. The question here that I'm asking is, how did I know Juniper would rally into that resistance here? If you remember if you didn't read it, the point of it was that it was kind of like my favorite bread and butter type of trade. It comes into different varieties. Again, I would say there's one favorite strategy I really like. I do a couple, 3 different strategies, but there's one I really like. And there's a couple different tactics, if you will, or a way to apply this favorite strategy, and this was one of them. And it was the Juniper trade. But in order for this to happen, when I saw it gapping down a little bit, and this is a 5-minute chart, so this is a small gap. This is like 20 cents or something. Yeah, it's like a 20-cent gap. It's not a big gap. But I wanted it to rally back to short it. And the question is, how did I know it would rally back into that area? Does anybody want to answer that for me? I'll give you a hint. It's in this section for a reason. How did I know it would rally back to that gap fill area? I look like a genius, don't I? Paul, you're waiting for that to rally back, and it rallied back. Boy, I should just let you think that. I just know what stocks are going to do ahead of time. Steve says I didn't. Ha, 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 ha. Anybody else have a different answer? How did I know that this stock would gap down? I was going to short it if and only if it went up into this area. How did I know that? Steve, you're all out there by yourself. Nobody's going to back you up at all. Well, guess what? It's almost like Steve saw the next slide. I didn't know. I didn't know. Well, is it my plan to make the stock rally? I can't make the stock rally. I mean, the point was I could be looking at Juniper and saying I want to short it, but what if it just dropped off the chart? Did I spell it wrong? I did it. I did it. Well, you're very quick on that. All right. So there's a typo in there. I didn't know. Right. But exactly. But look at my list, guys. You see the list? In other words, every day I go through this list and I go through and I place them on my screen. I have about 60 thumbnail charts, 60, and they're not all filled. I usually, fill them with about a dozen things, and I'm looking at those 12, 15, 18 things, waiting for it to do what I want it to do. So maybe I had 2 or 3 other favorites and they didn't do what I wanted them to do, so I let them go. And that's kind of what I do in the morning is I fill up my screen up with my favorites and I say, okay, these stocks here, I need to see them rally in order to short them. These stocks here, I need to see weakness in order to short them. This stock here has to pull back in order to go long. So I just kind of know where they're on my screen. So I'm talking and goofing around the room and I can just kind of look over and see what it is I want to do. And that's what I focus on, very focused for that variety of stocks, okay? My thumbnails change throughout the day. At open, if I'm going to trade the opening 10, 15 minutes, they have to be 1-minute charts that the thumbnails are on. But I then change them. As kind of basically as the opening bars go off the screen, I keep moving it up to 2-minute, 3-minute, 4-minute, 5-minute, whatever I feel like looking at. But yeah, they'll start off at 1 minute because, what else makes sense if you're going to trade something the opening minutes, if you're going to do that. So that is the whole first concept. Okay, the whole first concept about be focused, but yet have enough variety out there where you get that nice balance where you can find what you want to do. Okay? Number 2. Are there any questions on that, by the way? Are any questions on that? Feel free to throw out the questions. Number 2, be smart enough to be the second one through the door. Be smart enough to be the second one through the door. What the heck does that mean? Did I spell heck correctly? It came up as a typo, and I assume that Word just doesn't like the word heck, or PowerPoint, whatever, doesn't like the word heck. What does that mean? Am I trying to encourage you to wait or to be more aggressive? Well, I'm trying to encourage you to be more aggressive. One of the not so smart comments, wasn't that nicely phrased, by the way? Not so smart. One of the not so smart comments. I had a different word there before, and I changed it. One of the not so smart comments I hear is a trader that wants to see everyone get into something before they do. As a matter of fact, there's a misconception about volume. A lot of people think, I need to see big volume before I enter a trade. Well, it depends on the pattern, but in general, that's really a bad idea. Because if everyone is in, who's going to take you to your target? And it's not really a facetious question. It's quite true, right? So here's the bottom line of this one, is that we have to know the chart well enough to be in when we should be in, and the rest of the world enters, they take us to our target. Does that make sense, everybody? Again, it's a conceptual thing at this point. Just conceptually, does that make sense to you? If you look at a lot of your trades, if you do trade analysis after the fact, and go back and look at the charts and look at where you got in and where you got out, I almost guarantee you, unless you've done it before, unless you're good at reviewing your trades, I almost guarantee you that you will be shocked and amazed how late you get into things. How late you get into things. There's a trade-off to everything, of course, and you could say, well, if you get in too early, you might be wrong. Well, that's where the skill comes in to know that you're not wrong. And by the way, there's a reward to it. What's the reward for being the second one through the door rather than 99 out of 100? What's the reward for being the... And by the way, I say you don't want to be the first one because the first person often gets shot. In other words, we want a little bit of confirmation, a little bit. But once you know what you're doing, that confirmation can be very small. But what is the reward, if you will, for being the second one in the door? Right. Yeah. You catch most of the move. In other words, it's not just catching the move. Do you remember 1 or 2 presentations ago when I was talking about entries, right here in front of you guys? I did this little thing about how a late entry, it's not just that you miss a little bit of money, but sometimes it takes a winning trade and turns it into a loser. Do you guys remember that? Do you guys remember me doing that? If not, I mean, it's posted on the site. It was either the last one I did or the one before that. So it's not just, oh, I lost 10 cents of the move. No, it can mess you up in a way that it changes your management. And I've literally had it, even for myself, where I get taken out of a trade that ends up being a winner. So this turns out to kind of be, it has a snowball effect, in other words, and it can kind of actually end up being a big thing. How do you get to be able to do that? Well, it's simple. You get to know the charts really, really well, right? Someone else takes more of the risk. I'm not sure what that means. Well, yeah, kind of. Yeah, in other words, let's say you're looking at a breakout, right? And you let a couple other people, and of course I'm saying, when I'm saying the second through, I'm being facetious. I'm just kind of being hypothetical. Obviously, for a lot of these stocks, there's just thousands and thousands of people going in. So I'm just speaking relatively. Out of 100 people, I want to be maybe the top 5 or something through the door. But if you're the top one, a lot of times he's the test person. Boom, boom, boom. They get in first, and then whoop, they get whacked, and you go, boy, I'm glad that wasn't me, right? A breakout that doesn't work, a little buy setup that doesn't work. So I kind of want to see those test dummies go out there, right? If they come back all bloody, yeah, okay. If they come back all bloody, then I'm going to be like, okay, I'm not walking through the door, right? But if I don't see them again, then I'm like, okay, let's go through the door. But the point is, you don't wait until you're the last person there, because then you walk through the door and you're just standing there all by yourself saying, well, what's going on? And the rest of the world is at their target. So again, everything's a little bit of a balancing act, but for most people, you have to be, I hate to say this, but the truth of it is you have to be way more aggressive. But aggressive isn't really aggressive if you know the chart well enough. Example, MGM short yesterday. When do you short, guys, when do you short something? Give me a few answers. When do you short something? I mean, same question when you go long, I could ask either way, but the wording would just change. But when do you short something? What's just the general, you pick up the book on technical analysis that you find in the bottom of Boxer Crackerjack. What does it say? When do you short somebody? Well, when it's proven weakness, when it's in a downtrend, right? All these answers, right? And that's true. Those can be great entries, But the question often becomes, well, a downtrend on what time frame, right? A downtrend on what time frame? And sometimes it's because it's overbought. It's hard to define what overbought is, and then there's tactics or strategies that define overbought sometimes. But my point is, like in here, sometimes playing one time frame conservatively looks very aggressive on another time frame. The MGM short yesterday, which by the way, the MGM short came from a room member. You notice that wasn't on my list. It came from a room member. And I really liked it, and I watched it, and I shorted MGM right there. It was technically, the call was, and the entry was under 26.90. So I mean, we're talking, that's 4 cents off that high. That's not a lot of confirmation, right? That's very aggressive. That's extremely aggressive. I mean, like some people might yell at me and say, you're ridiculous. That's crazy aggressive. Well, it's not to me, because, and by the way, it bobbled, and the stop is not right there because you're aggressive with the entry. You can be a little more flexible with the stop. It went up another nickel, and then it fell really nicely. And because of that entry, and that alone made the day's goal. But it really isn't aggressive because, again, I knew to get in there. How did I know to get in there? How did I know that that was the area? Maybe not to the penny, not to 3 cents, but how did I know that was the area? How did I know? Right. You don't see it here, but there was something. Well, a lot of times, trader, it is luck, yeah. I find, though, that good luck comes to people who have better skill also, though. Because here's what it was. In other words, had I been watching this all day, I would have been waiting for it to come up here. It just happened that someone else in the room who thinks like I do and threw out a play at the right time was watching and said, hey, Paul, we're rallying right up into this prior high, a very extended move in this prior high. So I just needed to get it in this area, see any little thing that told me I wasn't the first through the door, and good to go. And then, look at the drop the thing had. Is that an unexpected drop? Not really. It's kind of just what it did. I mean, it did it here, Same move, same thing here. It's not anything off the chart. It's not a once a year move. It's just, hey, it was a good move, it was a nice move, but guess what? I also got it right off the top, which I think is very helpful a lot of times. And again, I want to remind you, this is from yesterday. If you let me search back for weeks, I could maybe find a better example of the point being made here. The point is, be the first one through be the second one through the door, excuse me. And that was a good example of it. Maybe not the best in the world, but again, it's from the last couple of days. Any questions so far? Think about this as well. If you are right, every penny you wait is a penny off of your target and onto your stop. In other words, it has kind of a two-prong effect, right? You ever think about that? And I'm saying every penny, it's true, it's every penny. It doesn't mean that you're necessarily watching every single penny, but even if it's a swing trade or whatever, every dime that you wait is a dime off of your target and onto your stop. It has like a two-prong effect, right? I mean, just think about that. Just think about that math for a minute. I mean, if you're taking a swing trade or something, and you say you're going for $1 target or whatever, I don't know, on a $20 stock, and you're thinking of getting in with a 25-cent stop and a 1 cent, you're thinking, well, it's 4-to-1, great, right? Well, if you wait 20 cents, guess what? That 20 cents gets added onto your stop, and it comes off of your target, and all of a sudden now you're less than 2-to-1, right? Not that that's necessarily bad. I'm just saying it has that double prong effect. So if you're right, you have to make money on your winners. So, act appropriately. And that comes through the skill and the confidence of knowing charts well enough. Okay? Worry about what you make and not what you miss. Here's another confusing one, because again, whenever I say some of these, there's so many sayings out there in trading that a saying may come to your mind, and it's not really the one I'm talking about. This is not the same as missed money is better than lost money. Let's talk about that saying, though, for a minute, because it may be confusing to not distinguish it, and also it is a saying that I've commented on before. I don't really like that saying. I think it's okay for new traders. I've said it to people. And there's a point and a purpose to saying the expression, missed money is better than lost money. It means that when you're a newer trader, you tend to overtrade. You're like a kid in a candy store. Everything looks good to you. You just keep hitting the button. And at some point, you got to say, wait a minute. You're just taking these trades. You're losing money. Let's let a few go by. Missed money is better than lost money. But then things change. You become a good trader. You have more winners than losers. You make more money than you lose. And all of a sudden, it flips around a little bit. And it also is not acceptable to miss good trades. Now, I'm not saying you're supposed to be monitoring and trading everything in the world out there that you could possibly see. But as you become clear in your strategies, it becomes more important to get in the proper ones. In other words, is missing a week's salary better than avoiding a stop out? Again, I don't want you to get the wrong idea. You have to be picky in particular. But what I'm saying is when you have it, when it's right, when it's your strategy, when it's time to go, you go, and you don't question it. Being too complacent is not acceptable. When I get mad, and I don't know, give me a 1 if you agree with this too. I'm not sure if it's a sign of experience or ignorance. I'm not really sure. But I don't get mad when I stop out. I get mad when I miss something I'm not supposed to miss. Can any of you relate to that? I don't really get mad when I stop out. I don't make a whole lot of mistakes. I mean, of course I make mistakes. I'm human. But it's not a ton of time that I take a trade and go, oh, crap, what was that? Sure, it happens, but that's fairly rare. Most of the time it's a trade, and I'm like, okay, you know what? I was a little aggressive, or it was a good trade, just didn't work, whatever it was. But I get mad when I miss something. But I'm supposed to make. Now here's where we're getting to the point of what this third topic is that I get mad if I miss something I was supposed to get. Okay? But I do not get mad when I miss things that I wasn't supposed to get. And that is the theme, the concept of this third tip. It's all about knowledge. Being too complacent is not acceptable. Once you are clear in what you want to trade, where you want to trade it, and when to trade it, then focus on trading it. Don't worry about anything else. Okay? But do not worry about everything else in the world. In other words, is this you? And please feel free to speak out. Nobody here really knows you other than a first name. Is this you? And it may be very helpful, just like kind of in Alcoholics Anonymous or whatever, to say, I have this problem. Is this you? If you're a day trader, are you afraid to leave the screen because you might miss something? And I don't mean that you're stalking a play that you love and you're waiting for. I mean, just in general, you're afraid if you leave, the market may move, some stock may do something crazy. Are you afraid to leave the screen? If you are, you have this problem I'm talking about. You come back from a break, or because you couldn't be there for a while, and then you lament over plays that you missed. And again, I don't mean something that you intended to trade that you missed. I mean, you just come back, you start looking through stocks, and you say, oh my gosh, look at this thing that moved, look at this thing that moved, oh, I could have been in this, I could have been in this. That's really a bad thing to have. I mean, to me, it's kind of a sign of being a novice trader. You can't worry about everything out there you could do. I know some people that go through the high of the day list at the end of the day, and they're looking at, oh, I could have done this, I could have done that. Who cares? You could have done a lot of stuff. You know, you could have tried all that stuff and lost on every single trade because you did it wrong. You need to focus on what you need to focus on and just forget everything else. I've even gotten really to the point over the last 2-3 years where I don't do a lot of additional scanning. I come to the market with my initial stuff, and it's kind of all I want to look at. Now, there are some days where things change or none of my stuff sets up, and I have a couple of pages of charts I look at to scan. I have a scanner I use to scan. And the room more and more is giving ideas. Can't wait for the scan team to be fully in place. We're going to talk about that tomorrow. So I think the focus is the key here, and then not worrying about what you don't focus on. Every minute of every day as a day trader, you're missing something. There's 2,000 stocks out there. You could maybe be trading 1,000. You could be trading certainly 300 to 500. You could be trading, and every minute of every day you're missing something. Don't worry about what you're missing. Worry about what you're making. Okay? Yeah, Robert, it's funny. I don't know if you've heard me say that or everybody does, but that's what I call it. I even call it, when I'm in the room, sometimes I'll say, okay, let's look at the woulda, coulda, shouldas, right? I'll go through the watch list. The woulda, coulda, shouldas. Well, I chose not to look at this, and look what it would have done. You know, the woulda, coulda, shouldas will drive you crazy, and it's worthless. What good does it do you? Unless, I mean, if it's stuff that you were looking at to trade and you chose not to, then there's a lesson, maybe. Why did I choose not to trade it? What made me pass it? Did I use the wrong entry? What happened? But just to go through random lists at the end of the day and say, oh my gosh, here's this stock that made this big move and I wasn't even looking at it. Who cares? You have to get over that. Constantly hopping back is the third thing. Is this you? Does anybody ever do this? I'm really curious. Constantly hopping back and forth, being at least mentally deciding if you want to be long or short the same stock or the same market. Does anybody ever do that? Like, oh, it's going here. It's oh, now I think it's a short. Oh, now I think it's a long. I mean, that's something I basically never do. Never. I don't flip around. I mean, when I see myself flipping on something, you know what it tells me? If you flip around on something, what does it tell me? What does it tell you? We can't be so precise that we're going to get, as a day trader, we're going to get this 30-cent move up, then we're going to get the 10-cent move down, then we're going to get this. And as a swing trader, I'm going to get this 80-cent move up, then I'm going to get a 40-cent. What does it tell you when you're flipping back and forth? Yeah, you're confused. When I'm confused, you know what I do? I immediately go to the next symbol. I'll say, oh, okay. I thought that was a long. Now I'm thinking short. You know what? Now, you could have stocks where that could be the plan. I'm not saying that that's impossible. I'm talking about when, rather than you dictating what the stock needs to be doing, the stock is dictating to you what you're doing, right? That's when you're confused, and that's when you need to kind of back away. Remember when I said I get mad? I don't get mad when I stop out. I do get mad if I miss something I was not supposed to miss. But I also do not get mad at things that I missed that I wasn't supposed to get, if that makes sense. I'll gladly repeat that because this whole night is a confusing night, if you ask me. Does that apply to indexes too? Oh, absolutely, yes. Everything is, it's extremely rare that I'd be saying something that doesn't apply long or short, index, stock, forex. It's a psychological thing. It really doesn't matter. I mean, I don't care what you're trading. What we're talking about is universal. Focus, not missing what you're supposed to get, not worrying about what you're not supposed to get. These things are all things that I think are, you know what they are? They're great tips to getting you on the right path to making money. Are we ready for the fourth one? The fourth one's a fun one. You ready for boy, I can't remember that saying. I think I know where it is on my computer. I'd have to pause a minute to get. Well, you know what? It's just kind of it's a cute, funny saying. You know where I got it from too? You want me to find it? All right, hang on one second. All right, here we go. This is not really directly related to this topic, but I remembered it and I thought it would be fun. Let me read this to you. It actually isn't confidence, it's experience, I guess. I remembered it wrong, but still think it's funny. A frustrated trader asks a successful trader, how do you get to be a successful trader? And the successful trader answers, good judgment. The frustrated trader asks, how do you get good judgment? And the trader answers, experience. And the trader asks, how do you get experience? And the experienced trader says, bad judgment. I don't know. I guess that wasn't as good as I thought it was. But anyways, I also thought it was confidence, so there we go. Confidence level. Let's go through what I want to talk about in confidence. This is going to be a fun section for you here, I think. I want you to take a minute here and actually look through this slide. Around, exactly. Okay. Trader Sally's results today. Sorry, Sally. Is Sally here? Didn't mean to pick on you. It just was a generic name I used. Trade 1 plus $200. Trade 2 plus $150. Trade 3 plus $50. Trade 4 plus $50. Trade 5 minus $500. Total minus $500. What? I want you to give me some real comments here. I want you to really think about this. And again, I want you to go through the thought process, really put some time into this for a minute or two and think about this. I'm going to sit here and babble. But give me some answers. What would your advice be to Sally? Sally sends you this. You're the experienced trader she's hitting for advice. And she says, here are my trades today. What would you say to her? Keep going. I want to see like 20 answers out there. Every third or fourth person has to give me an answer. Every fifth person has to give me an answer. All right, don't blow your stops. Position size, have a good stop. Quit for the day while you're ahead. Follow your plan and don't move your stop. Should never let the winning trades run. Keep, stop, never again. Do you know how to plan each? Know your rules. Stop trading after 3 wins. Stops are either not being taken or too wide. Do the opposite of what you're doing. You just said do the George. If your risk is $500, you are not letting your winners run. Well, Chuck really made the first really interesting comment, because my first question to you was going to be, is she blowing her stops? We honestly don't know. Let's assume that she is, right? Let's assume that these were decent trades, right? And you say to her, you know what? Looks like you should be using a $200 stop loss, right? You say to Sally, Sally, I'm not sure what your stop loss is. I think you didn't follow it, or you're using too much. How about if you would have enforced a $200 stop loss? What would Sally's results be? Somebody do the math. If she would have enforced a $200 stop loss, what would her results be? Real question. What would her results be if she enforced a $200 stop loss? And here come the numbers. We have plus 250, plus 250, plus 250, plus 200. Can't tell, plus 250. Can't be sure. You can't be sure because you're really bad at math, or You know, if I'm making fun of you, you know you have the right answer, right? Yeah. Let me show you her results. Let me show you her results enforcing a $200 loss minus the $1,000 for the day. Does everybody see that that is possible? In other words, yeah, she made 200, but what if she was down 300 before she made the 200? Same with this, same with this, same with this. So sure, she could have contained that loser. And to me, guys, this is one of the bigger things out there where people have a misconception about the whole thing about stop losses and how they work, what their point is. And you can't just look at something on a spreadsheet like this and make a conclusion. What do you have to do? To help Sally, what do you have to do? Mandatory. Matter of fact, you're doing her a disservice by even talking to her until you do what? Yeah, look at her actual trades on charts and understand what is the best way to pull together what she's doing. Maybe if her stop loss was $550, maybe she would have made $1,200 this day. You know, who knows? And again, you can't make your management or trading decisions based on a handful of trades, but over a period of time looking at this stuff. So, but I put this here. This is a little bonus. This really isn't directly related to confidence. I'm talking with my hands as if you could see me. This is not really related to confidence per se, but this is the first step kind of. Like I've done this before, and this is the first step in that understanding the results and trying to maximize what she did is not as simple as just simply saying, well, here you blew a stop loss. Let me show you the point of this slide. Well, here's a summary of it. You can't learn risk by just looking at trade results. You may find violations. Like if we knew her stop was 200, we know that she had a violation, but we don't know what the best thing for her to do is, right? Ironically, the things traders look at the least is where the real value lies in analysis of losing days. I'm not going to go into that right now, but that is a big thing. Now, tell me if this is not ironic. When you're new to trading, you start off risking $50, right? This is going to be the example. How's that for a trade if you're risking $50, made $200? How's that for a trade? Yeah, off the chart, home run. Literally a home run, 4-1. 150, not bad. Very good. $50, okay. $50, okay. Great day going. Oh, this is a typical new trader, right? Feels a little bulletproof, starts ignoring stops, and a good one bad trade wipes out several good trades, right? Let's fast forward this person a couple of years, right? And now they're so good, they're risking $500 per trade, right? And the first trade they pull in, well, that was minus 50 over. The first trade they pull in, $200. Well, made money, right? And you know what? You can't go broke taking a profit, right? So that was okay. 150, all right, still making money. 50, making money. 50, making money. And guess what? Didn't violate any rules at all, right? We're a good trader. We're not violating rules anymore. We didn't blow any stop losses. We're good traders. You get the point here? If you look at these results 2 years ago and today, guess what? Does this look familiar? This is a very, 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 very common thing for people. Does this look familiar, anybody? That your risk amount moves way up and you learn to not blow stops, but the trade-off is that you keep chipping out the small profits. Has anybody ever really done this analysis and found this is the case? Or if not, are you interested in doing this? It's amazing when you look at it, but this is a very, very true thing that happens a lot. One common adage that is completely wrong-headed is you can't go broke taking profits. That's precisely how many traders do go broke. While amateurs go broke by taking large losses, professionals go broke by taking small profits. William Eckert. There is no blanket answer. This is psychology that is only overcome through understanding the charts, analysis of trades from that understanding, and all of that leads to dun, 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 the title of this last section, confidence. In a sense, everyone, confidence is really the final mystical ingredient that I think makes you a good trader. A good trader coming off of some bad days or bad trades tends to go into a spiral because the lack of that confidence prevents them from doing the next trade properly. This is why I say, to me, the best person to learn trading is a video game player, because you can shake off that loss, hit the reset button, and do the next trade just like you would always do it. Human beings who get upset by that often start to do things differently. Being more cautious is not usually the right answer. You have perfected a way that you trade, and if you're doing well and making money, that is the happy medium you need to be in. And being more cautious is not necessarily going to make you more money. You have to hit that perfect sweet spot. You only get there through confidence. A confident trader that is trading his plan does well. It's when you lose confidence that the wheels start to fall off. Does that make sense? A final thought. If it helps, it is not about being right or wrong as much as it is about making money. Some people look at that and think that's a silly comment. It is not. It's a very true comment. I've said it all my trading career for the most part. I was looking through some stuff I wrote a long time ago, and I was actually amazed at how similar some of the comments are to stuff I still say today. This actually, you'd be in good company. This is a famous, well, it's very close to a famous Mark Douglas quote as well. It's not about being right or wrong. It's about making money. Don't think of it as a job. Have the confidence to always be right. No one is. Don't think of it as a job to have the confidence to always be right. No one is. No one is always right. And that's not where you get confidence from. You don't get confidence by always being right, because nobody is always right. Nobody is always right. Nobody. Not Trader 88, not Robert, not Murphy, not me, not Eric. Nobody is always right. I don't care how good you are. Nobody's always right. And if you measure your confidence by being right, you're going to have a hard time being confident. It's the confidence to know that you are playing the odds, and if you follow your rules, you will make money. It's the confidence about being right at the end of 20 trades, at the end of 50 trades, or at the end of whatever, that you know there are some that are going to bite the dust, and you know that you're taking great trades, that even though statistically some are not going to pan out, at the end of the day, week, month, you're going to be making money. That's where the confidence comes from. And one last chart example to make that point. This again was Monday or Tuesday, whatever it was. This is Disney. I told you I'm going to send out another little educational note to you guys, and it's going to be on this. It has nothing to do with what I'm talking about now. It's on a different topic. But this is Disney. I did not know Disney would crash. This obviously was a good trade. This is an hourly chart, so there's the prior day and here's yesterday. I didn't know Disney would crash. But what did I know? Well, I ended up shorting it right, that first topping tail right in there, okay, as it retested the prior high on the hourly chart. Why is this on my screen? I didn't know what would crash, right? Nobody would know that. But you know what I can say though? For some reason, out of hundreds of stocks, it was on my screen, right? That should tell you something. It had great potential. It had the day before. See, let me back up for a second and tell you the other story here. What you always hear me talking about a lot, one of my big themes, is what I call learning the language of charts. Just being able to look and read and understand what's going on. The battle of the bulls and the bears, as if it was a battle of armies. How to understand when one is winning or one is losing. It's not about trying to force everything into cookie cutter patterns. So when you look at a chart like this, what can you tell me about it? Yeah, Glenn, I mean, sort of. Disney, this was a relatively strong stock before this day. I didn't put the daily chart in here. You can look for yourself. It's Disney, DIS. But what I'm looking at is it had gapped down the day before. And when it gaps down, there's a question here, right? It actually, in a sense, hits support, if you want to call that. See, here's a great chart for that discussion, right? Did Disney gap To support or under support? If you even answer that question with a above or below, you don't understand trading. We don't measure this support area in terms of pennies. Does anybody here really think that you go over and you click here and if Disney gapped 3 cents below that number, it's a short, and if it gapped 3 cents above it, it's a long? Does anybody really think that makes any sense at all? You're going to say no, but yet a lot of people think that way when they trade, right? See, the question becomes, Disney does this, we want to see what does the world think? It doesn't matter what I think. It doesn't matter what Glenn thinks or what Murphy thinks. What does the world think? What do the people with all the money who are trading this, what do they think? Is it going down or going up? And we measure the response. We measure the battle of the bulls and the bears. Now, this was yesterday. I wasn't doing this yesterday. But what I see today, if I'm here, yesterday morning, if I'm here looking back, I see a stock that gapped down and stayed weak enough that it couldn't come close to filling that gap. It couldn't really come close to breaking this first minor resistance area, and then kind of sold off. The jury's not completely out yet in terms of where this is going, but I know this is something special. I know it could have great potential, and I know if I get a great entry, it's worth trading. What's a great entry? A retest of these prior highs. Because this is the moment in time. This is the line in the sand. This is the focal area, whatever term you want to use for it. That is where the voting is going to happen. And if I'm going to be wrong, I'm going to be wrong, and I'm going to give myself a good margin of error. And if I'm right, I know I could have a home run. That's something that I look for, is something that has a big potential like that. So it had great potential. It had a great entry. It was unique maybe on its own because of what happened the prior day. And I know that if I take all trades like this, odds in my favor, great entries, I do not chase them, I will win. That gives me confidence. That gives me confidence. That gives me confidence. Absolutely. Gives me confidence. Gives me confidence. All right. 3 typos in here. Too bad. You have to. Thanks, Marty. A light bulb. Almost at the very end, 6:01, I get 1 light bulb. Love the light bulbs. Thanks. Any questions? If you tuned in late, I did want to remind you, I will be sending out an email to all DTS members. It's going to be a boring email about the business in general. Some things you may or not be interested in. Feel free to delete it. I didn't interrupt this presentation for it, but I do want to remind you that I did start up a program for people who want to day trade that don't have the $25,000 that's required for day trading. I think it's the perfect solution. I know some of you, if you've never heard of proprietary trading, the whole concept to you will seem amazing. If you have heard of it, if you have reservations, all those reservations are taken care of. And you can feel free to email me if you want more information about that. But a couple of the things you need to know. You don't have to take any education or buy anything. There's no entrance fee. I have a deal out there for if you do want to. Your money is FDIC insured in New York, and you can be trading immediately your own money for real. So every little issue is taken care of. Thanks for the great presentation, guys. Great. All right. I'll leave that slide up there. I'm not going to talk about it more. Feel free to email if you have any questions. Are there any questions about the presentation? Any questions you want me to go over, review, talk about, or discuss? It's 6:04. I did pretty good on time. I always like to finish these up around 6 so you guys can plan your time accordingly and not be late for dinner. All right. Going once, going twice. All right, thanks, guys. Have a great rest of the evening.